Robschild. Welcome to the Macro Show. Although there are not many major changes in the macro data, I figured it's time for an update. It's been about a month. I view these daily reminders as sort of a compass for investors to really understand where we are in the business cycle, how the valuations of various markets compare to each other, why I hold the crystal ball ratings that I hold, and also a review of my portfolio. So let's dive right in. First point, the 3-month 10-year Treasury yields were inverted for over 2 years, normalization occurring on 12/13/2024, Friday the 13th. From the Federal Reserve Bank of St. Louis website, the FRED website, we have the 10-year Treasury constant maturity minus 3-month constant maturity. This is most people's favorite metric as far as yield curve inversion goes. Sometimes the 2-year, 10-year is used, but this one has proved to be more accurate as to predicting slowdowns, recessions. Although there's always a lag, when we get below zero, when you can lend your money for a shorter amount of time for a higher amount of yield, usually if you're going to lend your money out, you need a higher rate of return because it's going to be a while. Things could change. Inflation could go way up, and then the value of, your return doesn't look so good in the future. And so in normal conditions, the 10-year has to yield more than the 2-year. And when this chart drops below zero, it means we're in the opposite scenario. How this occurs is the Federal Reserve Bank that controls monetary policy for the United States, when they raise the very front end of the curve all the way up, they're trying to say, okay, economy, slow down. We're worried about inflation. We want things to not, get out of control. So when they do this, it's harder because it's more expensive to borrow money at a guaranteed rate. People that are borrowing money at a non-guaranteed rate have to borrow for even a higher amount. And so that already slows things down a bunch. And then it also encourages people and banks and institutions to stop investing and, save your money. These things are designed to help slow down the economy. And when that occurs, when they raise them enough, what happens is you can oftentimes get this inverted yield curve of when this metric goes below zero. And typically what happens with every cycle that we know of, when we uninvert, when we normalize, when we get back above zero, that's usually when the recession hits. This is largely seen as, okay, the Federal Reserve has indeed slowed the economy down enough so that inflation won't get out of control. But what happens is the effect of that slowing down, it tends to work like a ship. You turn the ship this way, the ship's not going to start turning that way until, for maybe an hour. And in the case of markets, it can take up to a year to really see the effects of monetary policy. Some people may even say longer than that, but I think 6 months to a year is the typical lag, I think. But anyway, when things get back to normal, we're done strangling the economy. That's typically when, okay, yeah, we did strangle it, so much so that we ended up in a recession like in 1990 here, that gray bar being a recession, dropping again below zero in 2000 and coming back above zero right as the dot-com bubble burst, with the dot-com little recession there. And then before the great financial crisis, if you knew anything about yield curve inversion back in July of 2006, you could have probably seen this coming eventually, because once we went back above zero, the great financial crisis occurred. More recently, and these look like little dips below zero compared to what we had recently. We have never seen this in history, apparently, from the sources I have, since right before the Great Depression. The last time we had an inversion anywhere near this deep or long was before the Great Depression, which tells me there's bad stuff coming, and it's coming soon, because we very, very recently uninverted in like I said, December 13th, Friday the 13th, 2024. And although we have not seen the recession clearly start yet, we know that we're headed into it because, as you can see, it can take a little while for the recession to actually hit. But sometimes it takes less time, sometimes it takes a little bit more time, but it's coming. But Robschild, what if the Federal Reserve didn't strangle the economy long enough and we're headed back into higher inflation? My answer to that is simply take a look at the 10-year break-even inflation rate, which has been in a range of only 2 to 2.6%. This is markets betting on the average inflation rate over the next 10 years. And this is priced by the difference between what you can get on a 10-year TIPS and a regular 10-year note. Some people like to use gold as a way of sniffing out inflation because, and some people say, you don't price gold in dollars, you price dollars in gold. It's nonsense to me. Gold has had very obvious periods of overvaluation and very obvious periods of extreme undervaluation. And right now, I mean, we're up there, but I'm not going to get into gold too much, other than you just mentioning it as, some sort of a false flag, the way that I see it, compared to the 10-year break-even inflation rate. So here it is in a chart again at the Fed. This chart currently looking back all the way to 2020, you can see really from 2021, the beginning of 2021, we've been in a range, bottoming around 2%, peaking at a very high at 3%, and then for the past 2 years since then, never getting back really above 2.6%, just going absolutely sideways here. This is not screaming inflation, as much as the people are getting a little overly excited about gold at the moment, and maybe Bitcoin too. It's not here. And we'll add to that in a moment with some of the other areas, the CPI. A little thing called the SOM rule, you can look it up. It was triggered in July of 2024. Every time that this has been triggered in the past, it has basically said, yep, it's a recession, and yet unemployment is still low. Oh, I need to update this. It's actually 4.0. So we have been going a little sideways in very recent months, but it was triggered in July of 2024, not saying that unemployment is super high yet, but that it went up enough to say, yeah, it's going to keep going up. And we can see how this works very clearly, again, at the Fed website. The unemployment rate, UNRATE, is the code for that. This current view of the chart goes back to 1950. You can see that when this is going up and up and up, that's a recession every single time. When we really think of recession, we think, it's hard to get work, it's hard to get jobs. Unemployment goes up, simply put. And the SOM rule, when the SOM rule triggers, it pretty much is like the beginning of every single one of these gray bars in very, financial crisis right here, spiking, even the .com bust spiking, 1990 spiking, 81, every recession, this is spiking. And right now, if we scroll in to this view of it going back to January of 2023, it's going up and up and up and up at a directionality that suggests, there's something coming. And then another piece of this that I wanted to include in this update is that the continued claims is currently paused. This is from weekly data that comes out, the jobless claim, initial jobless claims, and then you have continued jobless claims. They're continuing to claim unemployment. This is one of those metrics that climbed quite a bit higher from 2022 up until 2023, and then we were bumping up more gradually lately. And so I'm super interested to see if, are we really headed back down in the continued claims, or is this just another pause? Or we're kind of like winding up here, even for an explosion higher. Really, you need a crystal ball, for that one. But based on everything else, all of the other data, it suggests to me that this will probably spike higher. Yet it has not yet. Moving on, the S&P 500 is extremely expensive at a PE ratio of 30, a CAPE ratio of 38, and a dividend yield of 1.2%. From multpl.com, we see the S&P 500 PE ratio going back to 1871. This is the value of stocks. When you give your broker $100, and you say, "Hey, buy stocks, buy the S&P 500." Well, what you're doing is you're purchasing little chunks of companies. You own pieces of companies. Now, each chunk of company earns a certain amount of money. That's how it works. Now, when the PE ratio is higher, it means that the cost of earnings, the cost of money made by the companies is higher. It means people are paying more for the ownership of companies compared to the amount of return they can get. And sometimes this gets very, very cheap. In 1917, we can see it got all the way down to 5.74, 1949 all the way down to $6 for $1 of return. That's how this ratio works. You just look at the number, and that's how much $1 of return costs based on the company earnings of the S&P 500, all the companies combined. So 6.7% there. Sometimes it's only $6 or $7 for $1 of return. How much does it cost today to get $1 of return in the stock market? It costs $30. This is like historically high, and I know you see all these spikes here, the dot-com bust, the financial crisis. Part of the reason for these spikes is when you have major earnings contraction. So when you have earnings that contract majorly, where like the company can't make, aren't making any money because they can barely afford, the debt that they hold, which is the bond payments, the interest on their bonds they have to pay. When their earnings dries up, then this ratio also spikes, even when the stock market is crashing. You can see this spike sometimes. And so a lot of these spikes actually to the upside actually represent major earnings contraction, and yet we don't have that right now. We have not seen major earnings contraction. In fact, to prove the point, macrotrends.net shows a 90-year historical chart of the S&P 500 earnings, and as you can see here, the blue line here on the bottom here, that represents the price of the S&P 500, and this yellowy orangey line, let me zoom in a little bit more. It represents the earnings per share. So you pay $2,000, for example, August of 2014 for the S&P 500 for $106 per share of return. Now, sometimes when this drops significantly, that's when you can get that PE ratio to spike up, even though the price of the S&P 500 drops, because the earnings dropped all the way from $84 a share all the way down to $6 a share in the great financial crisis. Wow. That's why you see those spikes in that other chart. Now today, do we see one of these major earnings contractions where earnings just went down through the floor? Is that why the S&P 500 appears to be so expensive? No. In fact, we've been going sideways in the S&P 500 earnings since 2021. Not getting above 200, but also not dropping below 172. No major earnings contraction, not yet. Another way to see the value of the S&P 500 based on its earnings is called the Shiller PE ratio, also known as the CAPE ratio, and it's based on average inflation-adjusted earnings from the previous 10 years, known as the cyclically adjusted PE ratio. Now, very notably, this chart goes again all the way back to the 1870s, showing that, the typical range is, anywhere from, let's say, 10 to 23 We've sort of maintained that range for most of history. Yes, again, the dot-com bust, I do think this has, again, to do with earnings contraction, the move up here a little bit. But this was, stocks were definitely getting overvalued then. Everything was, I mean, that's why they called it the dot-com bubble, right? And then, the spike right before the Great Depression, 1929, we had gotten all the way up to 31, almost 31 and a half on the Cape-Shiller ratio before dropping precipitously down to 6.4 because the price of the S&P 500 had dropped so much that, that was like the point where it was very obvious that things were massively undervalued. If you were buying stocks in the 1930s, you would have done well for yourself. Well, what about today? Is it anywhere near 31? Yeah, 38. Try Child's Play, 1929. You have no idea how much people are willing to pay for stocks. I laugh because it is silly, and you should be laughing too. Stock valuations are extremely overvalued, and if we end up starting a correction in the price of the S&P 500 from this point, imagine the wealth effect going the opposite way when everyone says, uh-oh, wait a minute, I don't have as much money as I thought I had before. My investment account is like way lower. Apparently, I need to spend a little less money. And then what happens? Well, bad things happen. And when you have PE ratios this much higher than what is, a normal valuation, the amount that it can drop is very, very large just to get back to a reasonable valuation. This is a very, very serious matter, and most people are so blind to this that it makes me want to scream. But it is what it is. One last piece, as crazy as I sound about this, I will also add that bubbles can continue getting bigger. The bubble we're seeing right now is honestly a little small compared to what we saw in the Japanese stock market when it went off the charts. Bubbles can keep growing and they can keep getting bigger, but eventually it popped. Eventually every bubble pops because it has to pop, because it's just the way things work. So I think I explained all of that point pretty well. The next piece of this is that we have Treasury yields. This is on the wrong side of here. I'll put this here. Treasury yields equaling, as it stands today, to 11/20/25. We have the yield curve, Treasury yield curve, yielding between 4.25% and 4.76%. Currently, AA bonds, it's about 0.5% higher. So the lowest being about 4.75 and the highest being 5.25%. I mention this because Benjamin Graham is the one that uses AA bonds as his metric as to determine the value of bonds versus the values of stocks. And when you have a PE ratio of 30, that's the exact equivalent of a bond yield of 3%. And that's quite a bit lower than, 4.75% to 5.25%. And so at the very least, even for current stock valuations, let's say earnings don't contract somehow. Earnings stay steady, all right? And then yields drop to 3%. Okay, then maybe we have a little bit of some kind of equilibrium going on. That would make more sense to me. I am likely to get out of all of my bond positions around the 3% mark. But as it stands, the point of me mentioning this is simply that there is a huge mismatch between the valuations of stocks and the valuations of bonds right now. One other thing, again, that could make this make sense is if inflation was higher, if inflation was out of control, then yeah, stock valuation, and earnings can just expand. And then if earnings are, expanding massively, then that calms the PE ratio down. But we are not seeing that yet. We haven't seen that yet. I'll add to the scariness of this episode, the junk bond credit spreads are at historic tightness. Another chart from the Fed, the ICE Bank of America U.S. High Yield Index Option Adjusted Spread. In other words, how much more does a mom and pop shop have to pay to borrow money? What are their interest payments going to be compared to what you can get from the U.S. government, from a Treasury? Right now, it's only about, as of today, let's see here, it's 2.66%. Now, to some people that might make sense, except for the fact that if you look throughout history, it is extremely bizarre and rare. It almost never happens where this rating of borrowers drops below 3%. What this says is that people are willing to risk lending their money at a much higher risk for a much lower relative return to what we normally see throughout history. This current chart goes back to 1997, and there are very few periods where we have that spread below 3%. And in fact, in very bad times, you can have this spike up to as much as a 20% difference between what small-time borrowers have to pay to borrow money compared to what you can get on a Treasury. We also have spikes in 2011 going up to 8.4%, 7.7% in 2016, and even in March of 2020. This was a great time to buy high-yield corporate bonds when they got super cheap, when they had to pay way more. It just means that the value, the bonds being sold, no one, they were worried. These companies are not going to be able to pay their debt, so we have to sell the bonds at a much lower price. And when you do, it automatically makes the yield doesn't change. The amount of money they have to pay on the bonds doesn't change even when the price of the bond goes down. That's how you get these spikes. And then anybody that wants to open new credit, with that amount of risk has to pay that much more to borrow money. Again, the time to buy junk bonds is when they're cheap, not when they're expensive. And right now they are extremely expensive. I'm just going to also add, always remember, May of 2007, everyone thought that it was a great idea to lend their money to mom and pop shops for only 2.46% above the Treasury rate right before the great financial crisis, before this spiked all the way up to 20% difference, and then not getting back down to that low of 2.46% pretty much ever since then. We have not seen junk bond credit spreads get that low. And as it stands today, since this has been going down, if I highlight and zoom in on this area here, we're at the lowest that we've seen for decades at this point. This is called complacency. This is called people are, Mr. Market, he's lost his mind. He's lost his darn mind. One more piece, by the way, to the idea that the S&P 500 is extremely expensive, I forgot to mention and show the chart. The dividend yield is only 1.2%. Again, from multpl.com, we have a chart here that shows the S&P 500 dividend yield going back again to 1871. Now, believe it or not, before the 90s, stocks were expected to pay you money if you were a stockholder, anywhere between 2.7% in a normal range and as high as 5 or 6%, sometimes, getting enormously high, up to 8.7% here. In recent history, in 2000, it got as low as 1.17%. In other words, this dividend yield is how much, if you buy the S&P 500, you buy a piece of a collection of stocks, what is it actually paying you? How much money is going straight to you, without any nonsense going on? Well, it got to a historic low right before the dot-com bust of 1.11, and we are near historic lows today at 1.23% yield. Many economists today say, well, that's okay because the companies are just retaining more of their earnings in order to make you more money. The problem is companies don't typically last forever, even though, the idea of investing in a stock is that it has infinite duration. That's how it's structured. You own the stock forever. Even though it's like, okay, yeah, I can understand that, the company wants to take the money that it earned and, put it into something so it can make you more money. But, I have trouble trusting that that's the best way of doing things, especially when we look throughout history and see that it was normal for most of history for the form of investment of stock to yield between, 3 and, 5, 6, 9%. For me, this is just a sign of the past few decades as being way overly complacent. I mean, imagine we have a major stock market crash and people realize that, oh wait, bonds are yielding like this much, and if I buy this company, it's only yielding this much. If we ever get that normalization between bond yields and the dividend yield of the S&P 500, it's likely that we may see another 1930s era where stock valuations actually are like massively suppressed for a long period of time. I wouldn't be surprised to see that coming. Next, we have rate cuts began in September, November, December of 2024, cutting a total of 100 basis points. Looking at the chart trading economics, unfortunately, this doesn't show the gray bars of where the recessions are, but this is their chart of United States Fed funds interest rate. This is the overnight rate of the Fed funds rate, the very shortest lending amount that you can get for your money. This is what the central bank controls. And when they cut massively, like in 2000, that's the dot-com bust. When they cut in 2007, massively down, all the way to 0.25%. This was the great financial crisis. In 1990, we had a recession where we cut massively here. So although we haven't seen it go down all the way to the floor, not yet, we can definitely see that it certainly looks very reminiscent of past cutting cycles since 2000, where it just goes down and down and down and then just continues to go down basically to zero. I'm really curious to see if we'll flatten out here for any period of time. It's not possible to be 100% accurate that this is definitely going to go down to the floor, but this is more of a crystal ball rating, but it looks like we're headed there. You combine that with all of the other data out there. I mean, it is what it is. Another little indicator here that I want to point out is that the home price to income ratio is at record highs right now. There's a chart on longtermtrends.net that shows us the housing bubble. It might be hard to see here, but it says 6.78 years for the median household income. So if you line up 100 people and take the middle person, how many years does that person have to work, with their salary to be able to afford a home? And that was the housing bubble. It was like obscenely expensive, at 6.78 years. Before that, through the 1960s, 70s, and 90s, it was normal to work for 4 or 5 years, as low as 3.5 years, something like that. Housing bubble, 6.78%. And what happened since then? Well, we went down to a low of, almost 5 years for the median income to be able to buy a home. And then where are we today? We're solidly, largely, highly above the housing bubble right before the great financial crisis. Housing looks expensive. And what happens, when things get extremely expensive? Well, they tend to have something called reversion, which means get back to their normal state. This does not appear to be a normal state. Next item, leading indicators. Currently, I'll admit they look like they're pausing to some degree. From tradingeconomics.com, we see the U.S. leading index. This represents, it's supposed to be able to predict the turning points in the business cycle by about 7 months. So once this chart sort of turns the other way in about 7 months, things will follow, is the idea here. That's the theory behind it. And the components of this are average weekly hours in manufacturing, average weekly initial claims for unemployment insurance, manufacturers' new orders for consumer goods and materials, ISM index of new orders, manufacturers' new orders for non-defense capital goods excluding aircraft orders, building permits for new private housing units, the S&P 500 index of stock prices, the leading credit index, the interest rate spread, being the 10-year minus the Fed funds rate, and the average consumer expectations for business conditions. So this aggregates a whole bunch of stuff to help predict where we are in the business cycle. And what is it saying? Well, in the past, every time that this has gone down, it's been during a recession. 1973-74, the 1980 recession, 1990 recession, the dot-com bust, the great financial crisis, look at that, collapsing, the COVID bubble collapse, and what has happened since July of 2022, spiking downward. Now, I will zoom into this last point of this chart just to note that we did have a little bit of a bounce here, and that's why I sort of said having a pause here. I don't expect this pause to stay stable here, but I don't see exactly where it's going and how long it'll take to continue downward. I think it'll probably head down from here. Just look at it. If you were riding, this is not very good analysis, but if I was on a sled and I was riding down this hill, on the snowy mountain, is this it? Are we going down? Is this the bottom and we're just going to plane off, maybe even go up from here? Or is this just a bounce where, we're going to be headed lower? Notably, these past few months have gotten revised upward, which has been very interesting. And these numbers do get revised on sort of a rolling basis. And so you got to take the most recent readings of this a little bit with a grain of salt as well. I'm only suggesting that, maybe this last report was a little overly it could be overly optimistic. Also, the CPI, the Consumer Price Index, how much are people paying for stuff cooling? The one I like to look at is really the core, all items less food and energy. You can find this chart from the BLS. .gov. They have this chart here showing the inflation rate. This chart currently, you can see, goes back to 2004. Are we headed into more inflation? Are we at that part of the business cycle where things are, heating up? It doesn't look like that way to me. Since, again, 2022, pretty big drop. And again, it looks similar to the leading indicator, the leading index, going sideways a little bit here. I'll add at this point in the conversation something I brought up a while ago, I haven't talked about in a while. When we had the initial spike of inflation post-COVID, the Fed said we wanted to see it flat and then go up again. People are like, how did it get so high, up to 6 or 9% or whatever it was. They wanted that so that they could have yields be higher, so that they could, trickle them back down to zero. Because once you get to zero, as we've been near zero for so long, that's very problematic for the economy, for everybody. It's not a healthy situation to have Treasury bond yields not yielding anything. Look at what happened to Japan. So the Fed's perspective is, thank goodness we finally got some inflation here. And now we're being very hesitant about our cuts. We cut aggressively for the first cut, a first 50 basis point cut, followed by two 25 basis point cuts. And now we're pausing. Now we want to make sure that inflation is under control. It's the other side of the same mountain. We went up, we paused. We wanted to see it going up. It went up and it went up, and then the Fed strangled the economy. It went down. We may be pausing here for a little bit, but what happens after the pause? We're going back down, folks. I can see it very clearly in my crystal ball. Another thing that Lynn Alden and many others have referenced about, inflation perhaps not going back down here has been the idea that the new administration, President Trump and the gang, are not interested in being fiscally responsible. Yet I see headlines like saying Buffett is coming out and saying, me and Trump, we're not looking to control the Fed funds rate. We're looking to control the 10-year note yield. Well, no one controls the 10-note yield. That's the market that controls it. So in other words, he's saying, I want to do things that help interest rates go down. The only thing they can do is cut spending. And I'm seeing headline after headline of finding, with Elon Musk involved, they're looking ways to cut spending. They're aggressively trying to cut spending. That's what I'm seeing. And so this idea that there's not any fiscal responsibility, that we're not going to see the debt go down. Another headline that came out recently, with Trump saying, in one of his tweets, I believe, it was something like mentioning how, we're going to go through a period of pain. He's talking to the right people. He's talking to the money people that actually understand what the heck is going on. And that should be comforting in one way. And it's comforting to me to not have, this S&P 500 bubble continue to inflate to the point where when it does pop, the bigger the bubble, when it does pop, the harder that it's going to hurt. This is what happened in the Great Depression. This is what happened in the Japan bubble. This is what happens in many bubbles. The bigger the bubble gets, the harder the fall is, because just to revert back to normal valuations, like paying $10 for $1 of return to own a company. That's a normal way of investing, based on investment structure. The structure of investment hasn't changed over the past 150 years. We like to think that things have changed. They haven't. You have bonds that they're debt. They have interest payments that are a set amount of money, and then you have stocks that get the leftover profits. That's how it's structured. It hasn't changed for 150 years. And this nonsense about, well, maybe it's okay that stock valuations are this high is dangerous. It's very dangerous. We are in a hot air balloon, and we're apparently we're just looking up to see how high we can go without realizing how far we are off the ground. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.